Right now for the latest on the Fed's inflation fight and the rate path that we should be anticipating. For that, we want to bring in Dan Tarullo. He is former Fed governor who led the central bank's financial regulatory reforms in the wake of the financial crisis. He's now a Harvard Law School professor. And Daniel, thank you for joining us this morning. Joe was just referencing this huge spike we've seen in treasuries with the yields coming down pretty significantly. You've got the 10-year below 4.3%. Do you think the market is anticipating correctly what the Fed's next move is, that the next move will be a rate cut and maybe sooner rather than later?
Well, for one thing for sure, Becky, the market isn't paying too much attention to the dot plot than the change in the dot plot last week. I mean, I don't know. The markets go up, markets go down. They tend to overreact a bit to the latest string of data. So I'm not reading very much more into today's market reaction than I am to the dot plot last week.
We had Neel Kashkari, we heard over the weekend. He said on one of the news programs that he thinks that you will get one rate cut and it could be in December. Does that sound like a likely scenario?
It doesn't seem to be what the chair tried to project at his news conference last Wednesday, Becky. I mean, I thought Jay Powell went out of his way to present as neutrally as possible. He did a good bit of work trying to get people to de-emphasize the SEP, the dot plot. He emphasized that there had been progress on inflation, but they needed to see more. They needed to be more confident. He talked about the fact that the labor market struck him now as tight but not overheated. So I thought he was doing his best to preserve some optionality for the FOMC. And not to project anywhere. I mean, here's one thing to look at, to say, though. If you think there's going to be a September cut, they've got to set that up no later than Jackson Hole. And there are only 2 PCE readings between now and Jackson Hole. And so that means that either the chair and others on the committee need to be putting more emphasis on a cooling of the labor market, maybe moving from tight to strong, as well as a couple of good inflation prints. Or else, if they want more good inflation prints, September is going to be a little hard to pull off. But I think that goes back to the fact that Powell said we look at the totality of the data, which is a way of keeping optionality.
And I guess that's what you want at this point, to wait and really, if you're truly data dependent, you want to see what the next few prints are before you get too far out there?
Absolutely. I mean, look, sometimes in the past, I think it may have been fair to criticize the Fed for not having sort of a narrative and a view of how the economy was performing and what the key factors were. But at this point, after the last couple of years, it's pretty hard not to sympathize with their being more reliant on the past, the incoming data, and less confident about a projection of where things are going. I mean, just about everybody has been surprised multiple times in the past few years. And so I think their position and the chair's position is quite understandable right now.
Where do you think we are?
I continue to think that we are probably moving in the direction of that softer landing, maybe softish landing as opposed to totally soft. But, having said that, I'm going to go back to what I just said a minute ago, which is we all, myself included, have been surprised multiple times. And so, I wouldn't put any more confidence in my projection than in anybody else's.
In terms of the risks that are at play, I mean, you've got central banks in other places, including the ECB, already cutting rates. Does that put additional pressure on the Fed to do the same?
I don't think so, Becky. I mean, the economics of, say, Europe, the Eurozone, and the U.S. are pretty different right now. I mean, we have been quite resilient, I think, more than a lot of people expected. Even with some moderate cooling in the labor market, it's still pretty strong. I think most people are expecting GDP to be rebounding after the first quarter. And so under those circumstances, you face different economic circumstances. You've got to have a different monetary policy.
Dan, both political parties are talking about tariffs, ratcheting them up, using them more frequently. Does that cause you concern just in terms of what it will mean for our economy, what it will mean for what consumers pay, what it will mean for global trade?
Well, I think here's one perspective on it, that for many years, there was a rough consensus in the middle of both parties for tariff cutting and more trade. And, in all honesty, I think there was a lack of attention to some of the impact a lot of the impact that had on workers and communities throughout the country. And by the way, Becky, I think that lack of attention has fed into some of the political anger on both sides of the political spectrum that is so dominant now. Now we've got so you've got that in the background, and now we've got the additional issue of industrial policy, national security related trade activity. And I think that's why the situation you just described is the one we've got, which is both parties being not so free trade oriented. Obviously, the concern would be if it goes beyond a well thought through way of moderating, massive worker displacement or not protecting national security into a kind of just shutting down trade channels that people may not realize are important for, the kind of goods that all Americans have gotten used to. So I understand the direction that people have gone, and my concern is, is it going to be well thought through? Are people going to keep perspective as opposed to just kind of trying to one-up one another with more trade restrictive proposals?